Analyzing company financial statements is great fun. Simply by looking at all the information that's given to you and calculating and completing certain ratios, you can actually add color to a very black and white situation. You can then get an understanding of exactly what's going on in the business. So the reason that we analyze is because remember that the financial statements are there as information provided to the stakeholders to show how the business is doing. And this is the purpose of accounting. This is why you do all of those journals and ledgers and everything else, and why we draw up the financial statements. But then the stakeholders need to actually look at this information and make sense of it. If you're just looking at the statement of income and statement of financial position without actually analyzing and calculating ratios to compare the numbers, it won't have nearly as much meaning for you. It's pretty much like when you did a paint by number when you were a little child, and maybe there was a picture that you couldn't see what the picture was. It was just a bunch of lines and stripes and so on with little numbers all over. But as soon as you started coloring in all the number ones red and all the number twos orange, etc., suddenly a whole picture would emerge. The same thing is true of doing an analysis of financial statements. So we need to look at the financial statements and apply these ratios, which I'm going to show you, in order to try and identify problems that might be there, what could be done to fix them, are there any concerns that the stakeholders should have, and obviously the management, the directors would actually be able to try to implement solutions. Obviously the external stakeholders can only make decisions for their own purposes. So the first thing is analyzing the statement of income, looking at all the incomes and expenses. These can be compared to each other and to previous years, as well as maybe to the figures from other similar businesses in the same industry. Keep in mind that if you're going to compare figures to those of another business, it doesn't make sense to compare to a completely different business. You do want to look at something in the same industry to try and figure out what's actually happening. Little clue, the word margin means on sales. So any calculation that they give you with the word margin means you take whatever they've said over sales. Easy peasy. So the gross profit margin means gross profit over sales. Operating expenses margin is operating expenses over sales. Profit margin, if it's the net profit, it would be the net profit over sales, etc. So that's very easy to do. It is also possible to calculate the actual markup that you achieved by looking at the gross profit as a percentage of cost of sales. Note that this is different to the gross profit margin because one is looking at sales, one is looking at cost of sales. If you do the cost of sales one, you can see what markup you actually achieved, and it might not always be the same as what you intended. This might be for a number of reasons. If you're using the periodic inventory system, it is possible to try and identify maybe there's a stock loss along the way that you otherwise wouldn't be able to know, because obviously the cost of sales ended up being a whole lot more than what you expected or what it should have been for the sales that were actually generated. In the perpetual inventory system, you'd actually just look at what is the stock on hand compared to how much do I think there is, and that's how you'd find the loss. So please don't say that you can do the calculation of actual markup to identify stock loss in perpetual, because you can't. However, for both systems, if you have not managed to achieve the intended markup, it could be an indication that either your cost of sales is too high or your sales are too low for whatever reason. This could include things like having trade discounts or even just having errors. Sometimes you miscalculate something, and then if it gets recorded incorrectly, that would also have a result. Control of expenses is important. You can look at the operating expenses as a percentage of sales, in other words, the operating expenses margin, and compare it to what are other similar businesses spending on their expenses and what did you spend last year. And if you find that there are big changes, then do yourself a favor and just take two fingers and run your fingers down the two columns of all the detailed expenses and look at each item and see if anyone jumps out as being particularly large. When you compare your operating profit margin to your net profit margin, obviously the difference would be the interest. And so that would give you an indication of the effect of your financing and investing activities. Once you've finished looking at the statement of income, you want to look at your liquidity. Liquidity refers to how easily can debts be paid when they are due. So consider all the ratios together. I know you probably know that the current ratio is supposed to be 2:1, and asset test ratio should be 1:1. In reality, that's not actually the case. Many very solid businesses actually have a current ratio of 1.5:1. It depends on how much stock is the business actually holding, because obviously the less stock they're carrying, the less important it is to have a high current ratio. But it also depends on things like how long does it take to sell your inventory? Because if your inventory sells very quickly, again, it doesn't matter. You can have a lower ratio. You would also want to look at things like how long does it take customers to pay you, your debtors, and how long do you have to pay your suppliers? And if your customer terms are very short and you've got a long time to pay your suppliers, again, these ratios can be lower. Do yourself a favor, and instead of, when answering a question, referring to, oh, it's better than 2:1 or 1:1, because that's not really going to get you anything, rather talk about, this indicates that for every rand owed, there is however much available in current assets to pay it. But otherwise, an even better way is to talk about they are likely to be able to pay their debts as they become due, because they have enough current assets to offset the current liabilities. Something like that would be better. If you compare the current ratio to the asset test ratio, so if maybe your current ratio is 2.5 and your asset test ratio is 1,2, you can look at the difference between them. And that difference of 1,3 is actually the ratio of inventory to liabilities. Of course, you can work it out the long way around and then go and work out, well, what are my total current assets? What are my current assets excluding inventory, and subtract it. And in that way, you will be able to work out inventory. But this is quite a nice little clue that's a little bit faster. If you just look at the difference in the ratios, that gives you inventory to liabilities. And that's a very useful one to actually look at, because it tells you how much your stock holding is. Have you got lots and lots of inventory? And is that maybe why you might be having cash flow problems? You could then consider, why have you got so much inventory? Maybe you're trying to encourage more customers to come into your shop with a wider variety of goods available. Maybe you expect that you're not going to be able to buy a lot of stuff in the future because maybe there's expected to be a shortage, or possibly you expect the exchange rate to go adverse, so that if the exchange rate worsens, it's going to become more expensive for you to import stuff. You might then buy in bulk in advance. All of those might be reasons why you might hold lots and lots of stock. Obviously, stock holding has a whole lot of expenses associated with it, like storage and insurance, but more importantly, your money is tied up in that stock and you can't then use it to pay your other expenses, and more importantly, your current liabilities. So you can go and calculate how long does it take for your stock to sit on the shelf before it gets sold, or you can calculate how many times do you need to replenish it on the shelf in a particular period, like a year. These two calculations are very closely related, but they are slightly different. Be sure to read the question very, very carefully. If they just ask for the stock turnover, they want to know how many times do you replace the stock? And that's easy. It's your cost of sales divided by your average inventory, and that tells you how many times you would have to buy stock to replace what got sold. On the other hand, if you look at your stock period, that tells you how many days your items are sitting on the shelf before you actually sell them. And obviously, the shorter the period, the better for your cash flow. But a long period is not problematic if you can afford it, and obviously if the item is not perishable. Always be careful to read what business you are dealing with so that you can relate these answers to the kind of stock that you are carrying. When you're looking at your inventory period, also keep in mind that there are two ways that they can ask it. They can either ask, what is your average inventory period? In other words, how long does stock usually sit on the shelf? Then you use your average inventory. But sometimes they will say, how long will your current stock last you? So maybe there's a problem with a supplier and you want to know how long will you be able to survive without having to reorder new stock. In that second case, you only use the closing stock and not the average. So again, watch the wording very carefully. When you're calculating your inventory, debtors, or creditors time periods, the formula is very, very similar. Now, I know you've got the formula sheet, and that's great. You can go and look at it to check exactly. But it also helps if you can kind of just pull them out of your hat. It's a lot faster in the exam if you understand how to use them quickly. For all three of these, you use the average figure from the statement of financial position. And obviously, if you're looking for a stock period, you'll use stock. If you're looking at debtors, you'll use debtors. If you're looking at creditors, you'll use creditors, whichever ones you need. And then you'll times it by the number of days in the period. So if you've got figures for a year, you will say times 365. But if you've only got figures for a month, then you would say times 30. These figures will be divided by whatever figure relates to it on the statement of income. So debtors, you would need to go and look at your credit sales, whereas for stock and for creditors, you would use your cost of sales. In reality, for creditors, you actually want to use credit purchases, but you're not always given enough information to actually get that specific, and then you use the closest thing available, which would be cost of sales. You might have wondered why some figures on the of these calculations have to be averaged and other ratios don't have an average. It's quite simple. If you're looking at a statement of income, it's for a period of time. So you're looking over a year or a month or whatever period it is. If you're looking at a statement of financial position, it is only at a point in time. So that is not really easy to compare to a whole period like a year. So what we do is we take the figure at the beginning of the year and at the end of the year, and we average them so that it's a better comparison to the statement of income. So any time that you are comparing figures from both financial statements, then you will average the statement of financial position figure. If they give you the credit figures for credit sales and credit purchases, please do use those. You usually just times by the relevant percentage. If they don't, then as I said, just use the closest thing that you've got, which would be sales or cost of sales. You can also work out your working capital cycle, which means basically how long does it take for your money to go through the whole operating process in your business. In other words, if you spend money on something, how long does it take for you to get it back? Now, what you do there is you take your stock period plus your receivables period, because you would have to buy the stock and then sell it and wait for the customers to pay you. If you can do that in a time period that is shorter than the time it takes to pay your suppliers, then you've got a lovely positive working capital cycle, and it means you actually don't need to put any working capital into the business, because in fact your suppliers are financing your working capital. That is an ideal situation. It's not always possible. It depends on the nature of the business. It depends on who you're dealing with, but that is the goal. That's what you'd like to achieve. Right, we're now going to look at gearing. You're probably, most of you, already learning to drive or driving already. Some of you might even have your driver's license. So I'm hoping that a car analogy will make sense to you. If it doesn't, go talk to a friend who can drive and they'll explain it. In a car, the concept of gearing is simply that the lower gear you are in, the less result you'll get for what effort. So if, for example, in a car, you've got gears 1 to 5, and 1 will take you very slowly. It's what you'll use to pull off. And then gear 5 might be when you're busy zooming down the freeway very quickly. This is showing the relationship between your accelerator. How much do you push on your accelerator compared to the speed or the distance that you're able to cover in a certain time? If we're looking at our business and we talk about gearing, it's a very similar concept because it's still looking at what effort gets put in and what comes out. For the business, we are, instead of referring to, well, what speed do we get, we're looking at how much borrowed capital is being used. And we're looking at a ratio of our non-current liabilities to our equity. If you are saying that the business or the car is highly or lowly geared, for the car, you know, the 5th gear is fast on the freeway, 1st gear is slow pulling out of your driveway. For a business, if a business is highly geared, it means there's a lot of debt. There's lots of borrowed money in the long term. If they are lowly geared, we say there's only a little bit of debt because there's only a little bit of borrowed money going into this equation. This looks at how creditworthy is the business, because if they have got a lot of money that has been borrowed, one might be a little bit tentative about lending more, because can they actually afford to pay it back? And how risky is it? Because they might have a very high risk of bankruptcy. And then if you lend the money, you're not going to get anything out. So from the business perspective, you want to look very carefully at how highly or lowly geared you are, because this might determine your creditworthiness and will you be able to get a loan. Obviously, lenders will also look at things like how much profits are you making, etc. But this is your starting point. And it's very important to understand your highly versus lowly geared tells you your risk and can you get a loan or not. If you are looking at positively or negatively geared, remember that this is a different concept. It's very important to realize it's not the same as being highly or lowly geared. I know it sounds like it because high sounds like positive and low sounds like negative, but it really isn't. In the case of a car, it's the difference between being in 1st or 5th gear versus going forwards or going backwards. You can see the concept is not the same. So positively geared would mean you're going forwards. Negatively geared means you're going in reverse. For your business, you would compare your return on capital employed. Remember, that's a calculation where you take your profit before the interest on loan and you compare it to your total capital employed. In other words, your equity and your non-current liabilities. And you compare that answer that you get as a percentage to the interest on the loan. And if your interest on loan is lower than your return, you are smiling, because it means you can borrow money from whoever you're borrowing from, put it in the business, generate a nice big fat return, pay off the interest, and you get to keep the rest. The rest is yours. So that's quite a nice situation to be in. And that's when we say the business is positively geared. However, the reverse can be true too. If you borrow money, for example, at 10%, you pop it into your business and the business only spews out 7% return, that means that you are going to lose 3% because you're going to have to add 3% to that 7 to give 10% back to the bank or whoever lent you the money. So this calculation will determine, do you want a loan? Because obviously if you're negatively geared, no, you don't want lots of loans. But if you're positively geared, great. So how does this relate to the car scenario? You can imagine it like this. As I've said, highly or lowly geared is, are you going fast or slow? Negatively and positively is, are you going forwards or backwards? You want to make sure that you are going forwards if you are going very fast. So if you are highly geared, it will only work if you are positively geared. If you are negatively geared, then you need to be going slowly. There's a reason cars don't have 5 reverse gears. When completing your gearing calculations, notice that the same figures are used when calculating your gearing or debt equity and your return on capital employed. In other words, your non-current liabilities and your equity. It's the same figures that go in both of them. For debt equity, it's obviously going to be your non-current liabilities compared to your total equity. I quite like this ratio because debt to equity tells you what you need. There's very little that you actually need to remember there. So debt is your non-current liabilities. When you're doing your return on capital employed, you want to use your profit before the interest on loan and then compare that to your non-current liabilities and equity. Can you see it's those same figures again that are going to go on the bottom of that calculation? Companies have some special ratios just for them. The first, obviously, is your return on equity. Similarly to how you would have calculated for a sole trader, you would put profit over the capital. But now we want to use profit after tax because the shareholders will not see that tax at all. So you've got to take the profit after tax and compare it to equity. Remember to use all your equity and obviously average it because you're comparing statement of income to statement of financial position. All of equity means you want to use your share capital and your retained earnings. The net asset value per share actually means your equity over your number of shares. And that's because the word net means something has been subtracted. What could you subtract from your assets? Your liabilities. And if you look at assets minus liabilities, hopefully little bells are ringing and you're remembering this is your accounting equation. And that's how you get net asset value is actually your equity per share. Why they don't actually just call it equity per share to make it easier for you, I'm not sure. But just keep in mind that's what they're talking about. This you would want to compare to the market price on the JSE, and the market price might be higher or lower because remember that they will be buying and selling shares without any effect happening to the company itself. Because the buying and selling over there, the money that is being changing hands is only between the buyers and sellers, not the company. So out there, the supply and demand will determine the market price on the JSE. If people have got a lot of confidence in the business and they think that there's potential for a lot of future profits, then you would expect the market price to be higher than the net asset value. And of course, the reverse is also true. If the net asset value is a certain number and the shareholders don't actually trust that, or they think maybe there's something wrong in the financial statements, or maybe they just think that the business is actually going downhill and they just want to get out fast, then you'll see that the JSE price would be lower than the net asset value. Earnings per share is literally your profit after tax, which is earnings divided by your shares. Very simple to calculate. You just use the last number on the statement of income divided by your number of shares. Technically, it should be the weighted average number of shares, but don't worry, you don't have to do that. You can just take the last number of shares at the very end of the year. If, however, you calculate the EPS and you compare it to published financial statements EPS, you might see that there's a slight discrepancy, and it's because of that little nuance over there. By earnings, we just mean profits. So just keep that in mind. You would want to compare your earnings to the dividends. Earnings is what the company made. Dividends is what they actually paid out to shareholders. And usually you would find that they won't pay out all the earnings. A very common policy would be approximately 50%. So they give 50% to the shareholders and they keep 50% back in the business to use for future expansion or whatever they want to do in the business. That will then just grow the retained earnings. And then they could use that in the future, maybe to buy back shares and consolidate control, etc. It is possible that your DPS could be higher than your EPS if perhaps they're paying out profits that were made last year and maybe they were a little bit more conservative and hesitant about what they're paying out. It is possible that it might be paid out now. Sometimes you'll also find that the dividends might be higher than the earnings if maybe the earnings weren't that hot and the directors are hoping to bluff the shareholders a little bit, and some shareholders won't even bother to check the earnings. They'll just go, yay, I got dividends in my bank account, fabulous. And they might not realize that actually the company is not doing as well as it should. When you're analyzing company information, make sure that you practice analyzing real published financial statements, because that's what you're going to get in the exam. Usually they will simplify them a little bit for you so that they're not so scary, but there will also sometimes be terms in there that you haven't seen before, because we want to just see, can you use the common sense that you've got combined with the principles that we've taught you to be able to come to your own conclusions. Analyzing real financial statements is very, very interesting, because you can come out with a lot of interesting information, details about the company and what they're doing and how they're doing things, and you can start predicting what you think might actually happen in the future. Give it a try just for fun. Just Google any company that you feel like investigating, Google financial statements for that company, and you'll be able to download them and have a look at them. When you're using exam papers, make sure that you read the case study information very, very carefully. When you're answering questions, we do expect you to use the information that has been provided, and every piece of information that's given has been given for a reason. So make sure that when you are answering the questions, you relate your answers to the given case study and use the information, quote figures, relate different aspects to each other, show the links that you can see between different pieces of information. While you're working through it, you might find it quite useful to highlight relevant points, or even write little notes in the margin about things that you notice or pick up as you're going through them. And that's what I mean when I say predict the links or the questions while you're reading. It's very easy to actually look at a piece of information and with practice realize, oh, they are going to ask me X, Y, Z. And then when you come to the question, it's a lot easier because you've already predicted it. Make sure that you are using actual information, or be aware of real current affairs. So have some discussions with your teacher, with your classmates, read some of the news on News 24 or any news websites, and keep in mind what is the prime interest rate at the moment, etc., so that when you're answering your questions, you are able to refer back to those kinds of situations. What is the economy doing? How much inflation do we have, etc.? All of those things can be used in answering your question.